I think investors' patience is clearly tested because I think Bitcoin's been down 3 quarters in a row, but I think it's never been down 4 quarters in a row. So this would be a test that if they don't bounce from June to September, then you're right, maybe something's broken. For Bitcoin, the way to look at it is its production cost, because there is a cost of mining and to find the next block. And I think Bitcoin is like 5% below production cost right now. If Bitcoin falls below 50% of production cost, it literally it means you just take down the network. You can't support managing the Bitcoin network with its current price. I mean, that to me, that would be the equivalent of like JP Morgan trading at half of book value.
For years, Tom Lee has been one of Wall Street's most consistent long-term Bitcoin bulls. Through brutal bear markets, spectacular rallies, regulatory uncertainty, and endless predictions of Bitcoin's demise, he has repeatedly argued that the long-term thesis remains intact. That's why this latest interview immediately stands out. For perhaps the first time in a very long time, Lee isn't simply dismissing the weakness. Instead, he's acknowledging that investors' patience is being pushed to the limit. After 3 consecutive losing quarters, Bitcoin is entering what he sees as a genuinely important test one that could determine whether this is just another painful cycle or something far more significant. According to Lee, history is on Bitcoin's side. The asset has never recorded 4 consecutive quarters of declines, making the period ahead unusually important. If Bitcoin fails to recover over the next quarter, even someone as optimistic as Tom Lee admits investors would have legitimate reasons to start asking difficult questions. That doesn't mean he's abandoning his bullish outlook, not even close, but it does mean the burden of proof is beginning to shift back onto the market. For long-term holders, institutions, and even skeptics watching from the sidelines, the next few months could become one of the most closely watched periods of this entire cycle. But that's only one side of the conversation. Throughout this interview, Tom Lee also explains why he believes blockchain technology continues to solve problems that traditional finance still cannot, why Wall Street continues pouring billions into tokenization despite disappointing crypto prices, why artificial intelligence may actually strengthen the long-term case for blockchain, and why today's macroeconomic environment has temporarily diverted both investor attention and capital away from digital assets. He also shares why he still expects Bitcoin to recover, while offering fresh insight into the broader stock market, corporate earnings, and the AI investment boom that continues reshaping global markets. Before we jump into Tom Lee's full analysis, take a second to support the channel. If you enjoy thoughtful, data-driven discussions on Bitcoin, crypto, macroeconomics, and the financial markets, please give this video a like, subscribe if you're new, and turn on post notifications so you never miss our latest uploads. Now, let's hear exactly why one of Wall Street's most respected market strategists believes Bitcoin is approaching a critical moment, and why he still isn't ready to give up on the bigger picture.
The reason we were bullish on crypto at the start of this year and really for the last 10 years is that cryptocurrencies and blockchains do solve an important problem, which is how do you do trusted transactions between 2 untrusted parties? And that type of settlement and finality has been proven because, Bitcoin and Ethereum in their entire history has never recorded a fraudulent entry. And that is why, Wall Street is building tokenized assets and building stablecoin rails. And I think over time, using blockchain actually as a replacement for a lot of the legacy financial rails. For instance, there's a Goldman Sachs conference in Europe, in London today, and the number of attendees is actually almost tripled from a year ago. Similarly, I'm bullish on crypto because I think as agents and AI become a lot wealthier, and we're starting to see, agents create wealth for us and robots create wealth for us. To us, the opportunity is that we may be reaching a point where agents actually own more wealth than we do. And I'm going to call that the, quote, uncanny valley of wealth. That there may be a point in time where if our delegated agents make more money than us, we're going to wonder if we work for them or they work for us. And I think that is the reason why crypto and a lot of the technologists are starting to realize that crypto is really one of the ways for humans to control the future role of agents. So I think those two mega trends are still in place, but crypto prices have been absolutely terrible this year. I think part of it is macro. The monetary policy is not dovish. It looked dovish 6 months ago, right? Market was looking for 2 cuts. Now it's 2 hikes. That's a headwind. The Clarity Act, which was supposed to help provide and create federal preemption of cryptocurrency rules and let the CFTC essentially have purview over that industry, that's still stuck in the Congress processes. And AI, of course, has done so well that I think it's not only taken away attention, but it's actually taken away investor capital. So I think those are, to me, headwinds, but they're not creating what I call intermodal replacements. I think blockchain is still going to be central to the future of the financial services industry and actually to how we manage AI. Crypto is hyper volatile. So Bitcoin's fall from 120,000 to 58,000, and Ethereum, which is beta to Bitcoin, falling from 5,000 to 1,600. That's fall still within the historical parameters of like the crypto bull and bear market cycles. So price hasn't moved to a level that would say anything's broken. But what has been broken is the fact that stocks have done well this year and crypto's done badly. I think part of it is some of the macro things and that Scott and I discussed, like the Fed becoming a little more hawkish and AI really taking away some capital, and the Clarity Act and that the positive exemption that would come with it not happening just yet. But none of those really break the crypto story because as a quote mousetrap, blockchain is still the best way to still transmit and store value and record transactions without trust. And that's why I think Wall Street is still going to build and is rapidly building on blockchains. It's just not happening to our everyday lives just yet. And for the same reason why I think a lot of the AI engineers are tinkering with using blockchain to manage future agents to protect us, because as AI becomes quite wealthy, humans might be taken out of that economic loop, So I think that's why, to me, Bitcoin will make a full recovery. I believe you're going to see Bitcoin over 100,000 by the end of the year, and Ethereum, back to over 5,000. So, I think investors' patience is clearly tested because I think Bitcoin's been down 3 quarters in a row. But I think it's never been down 4 quarters in a row. So this would be a test that if they don't bounce from June to September, then you're right, maybe something's broken.
Is there a price point at which you would say, yes, it is broken, the story is broken, and it won't work anymore? Like, do you ever think about that?
For Bitcoin, the way to look at it is its production cost, because there is a cost of mining and to find the next block. And I think Bitcoin is like 5% below production cost right now. If Bitcoin falls below 50% of production cost, it literally it means you just take down the network. You can't support managing the Bitcoin network with its current price. I mean, that to me, that would be the equivalent of like JP Morgan trading at half of book value.
Tom Lee's argument ultimately comes down to separating temporary market pain from permanent structural damage. Yes, crypto has dramatically underperformed expectations. And yes, several powerful headwinds, including tighter monetary policy, delayed regulatory clarity, and the explosive rise of AI, have pulled both attention and investment capital away from digital assets. But in Lee's view, none of those developments change the underlying reason blockchain exists. And if blockchain remains the most reliable system for transferring value without trust, then today's weak prices may simply reflect an unfavorable macro backdrop rather than a broken technology. That distinction is central to why he continues forecasting a meaningful recovery, even while acknowledging that investor patience is wearing thin. The conversation then widens beyond crypto into the broader investment landscape. Tom Lee explains why he remains constructive on equities despite growing concerns over market valuations, examines whether the powerful AI-driven rally still has room to continue, and discusses the risks that could emerge if the artificial intelligence narrative begins to lose momentum. As capital continues flowing between stocks, AI, and digital assets, understanding how these massive trends interact could prove just as important as following Bitcoin's price alone.
2026 is tracking to be the fourth year of double-digit gains. It may surprise viewers, but when markets post 3 years of strong gains, which we've seen 2023, 2024, 2025, the fourth year actually tends to be pretty solid. That was one reason we were constructive. And at the start of this year, the thought was that the earnings could be the driver of the markets. And that's been the case because at the start of this year, 2027 S&P earnings consensus, and very similar to ours, was $350. And now it's currently $400. So it's risen by $50. And the PE on 2027 earnings was at 19.4 at the start of the year. It's now at 18.4. So the stock market, which might surprise people, has actually gotten cheaper now than it was in January, even though we're 9% higher. I think it makes a lot of sense to be constructive here because I do think there's room for earnings to further revise higher for the U.S. The drivers of earnings have remained in place. Part of it is this AI and energy infrastructure build that's taking place. Part of it is this trend towards onshoring. And of course, there's still some residual infrastructure spending by the government. So those are all tailwinds to spending. And I think for the most part, investor sentiment has not become ebullient, but there are two sort of other factors to weigh in now that we're mid-year. One is that margin debt is much, much higher now than it was at the start of the year. In fact, it's risen 55% year over year. That is, I think, the fifth highest year-over-year increase ever in almost 70 years. And historically, that's associated with that cohort of traders, that borrow money running out of firepower. But on the flip side, when we look at fund manager performance this year, looking at large cap growth, 76% of fund managers are trailing their benchmark this year, which is a pretty historic number. On large cap blend, 60%, which is not as historic. So today, I would say growth managers probably missed a lot of that semi and DRAM rally. I think they're going to be chasing it in the second half, which is why I would probably stay bullish.
Do you have any fear that we are starting to see some cracks in the, I don't want to call it the AI bubble, but in the AI story, and that would ripple through the markets, or are you less worried?
Well, there's a lot of things that can go wrong with the AI story, Scott, and Ed, because one, as you know, we have to build a parallel amount of power and infrastructure to support all this. Getting all that built is an enormous lift. I mean, we won't even really know what it means for residential electricity prices, right? Or like environmental damage, or like quality of life if you live around a hyperscaler, a data center. And I think that we don't exactly know why both Anthropic and OpenAI delayed their IPOs. I think that's actually very curious because both would benefit from one going public first. Nobody would want to be last, I think it's possible it has to do with the U.S. government throttling new models, right? Because like Mythos faced a lot of scrutiny, and then Fable had to get pulled. Is it possible the U.S. government is actually saying we got to look at all your models now, and then they got to throttle their plans? Maybe, I don't know. I mean, but to me, it's curious. I actually think SpaceX is a huge success. So I don't think SpaceX has anything to do with OpenAI and Anthropic slowing their IPOs.
One of the most interesting aspects of Tom Lee's outlook is that it refuses to fall into either extreme. He isn't declaring that everything is fine, nor is he suggesting that Bitcoin's long-term story has failed. Instead, he's acknowledging something many investors have been feeling for months: this market has become much harder to navigate. Crypto has struggled while equities have continued reaching new highs. AI has captured an enormous share of global investment capital, and uncertainty surrounding monetary policy has created an environment where even fundamentally strong assets can remain under pressure longer than many expect. At the same time, Lee believes the forces that originally convinced him to become bullish have not disappeared. Financial institutions are still investing heavily in blockchain infrastructure. Tokenization continues moving from theory into real-world implementation. Stablecoins are becoming increasingly important to global finance. And perhaps most intriguingly, Lee argues that artificial intelligence itself could eventually increase the importance of decentralized blockchain networks as autonomous agents begin participating more actively in the digital economy. From his perspective, these are structural developments that extend well beyond today's market cycle. Even so, Lee isn't asking investors to ignore the warning signs. His comments about Bitcoin approaching a critical historical test and his emphasis on monitoring production costs rather than emotional market swings show that disciplined investing requires constantly reassessing the evidence. Markets evolve, narratives change, and even the strongest long-term convictions should be tested against new information. The next quarter, therefore, could become one of the most important periods for confirming whether this remains another painful but normal crypto cycle, or whether investors truly need to reconsider their assumptions. That makes the months ahead especially important not just for crypto investors, but for anyone trying to understand where capital is flowing in the next decade. If you enjoyed this breakdown, please give the video a like, subscribe to the channel, and turn on post notifications so you never miss our latest coverage of Bitcoin, crypto, macroeconomics, and the markets. Thanks so much for watching, and we'll see you in the next video.